Okay, everyone, welcome back to the channel. Matt with Green Bar Trading here. Welcome back to another weekly watch list video, and we're going to go over a whole bunch of information in this video. These videos are packed with really important information of what to look for the week ahead, because you have to be prepared. You have to know your earnings, your economic calendar. You have to know the market sentiment, the technicals. There's a lot to go over. So we're going to start out where we always start out, with the earnings for the week. Now, earnings season officially starts this week, and it always kicks off with the banks and Delta, and that's on Friday. We need to really listen to what those CEOs say, really listen to those reports, the guidance, what they see with the consumer, the credit cards, that type of stuff. Very interested in seeing all of that. And, you know, since the last earnings report, what they started to make a lot of money on was bond trading, because bonds were really, really bad early on, and then they started to trade them, and that was a good source of earnings for them. So, you know, we'll see what happens with those, but that's the first thing to watch for, because earnings this year is going to be really important, at least for the current market direction, and we're going to want to see what they say. So that's the earnings for the week, the economic calendar for the week. Now, I decided this week to put on an economic calendar that has other countries on it, because there's a lot of inflation and GDP data coming out from other countries, including the UK, including China, Japan, so Germany. So it's good to know how the entire world is operating. So in our country, the most important day is going to be on Thursday. You have our CPI report. It's a huge one. So we'll see that on Thursday. You also have, looking on Tuesday, you have Powell speaking in Sweden. All right? That's going to be on Tuesday at 4:30 a.m. So that's going to be well before the market opens. So a lot going on this week. Earnings season kicks off. The economic calendar is full of Fed speak. It's full of very important data. So this week should be very interesting. All right, so that's the economic calendar. Let's go over to the sectors for the week, for the month, and especially what I want to show you guys is this 3-month relative performance. Now, all this does is it breaks down by sector how they have done. All right, basic materials, technology, real estate. You can see here. It does the 1 day, for the week, for the month, but look at the 3-month, and this is really important. So since October, basically, the market has held up, right? We've had our ups, we've had our downs, but what I want to look at the most is that 3-month relative performance, even the half-year relative performance down here, because I really think what has done well in October, in November, in December, has a very good chance to become those leaders for 2023. And what was the leaders back in 2000, even for the last 13 years, 12 years, 10 years, has been, you know, technology. And they have really, technology, I mean, it is a great place to be. Their growth is really good. You kind of like that when inflation is high, because their growth is high, but it does hurt that to a degree. Technology is always going to be one of my favorites, but I have to, you know, just look at what I'm looking at here and see that last year's leaders, the leaders that took the market up, it's starting to revolve. It's starting to change a little bit. And we're seeing the Dow Jones really take that lead. It had the best year last year. On a relative performance, it's still lost for the year, but that's where a lot of these are. The energy stocks, the utilities, the finance, the healthcare, the consumer defensive, the materials, the industrials. So we're going to want to take a look at that and see if that can continue. And that's where the 3 month relative performance is really painting a picture to me, um, for the next maybe half of the year, this half of the year coming up, to see if they could continue where they left off. Now, recession fears are always going to be there. That's why earnings season is going to be so important this earnings season. All right, so the next thing I want to show you guys is what happened on Friday, right? So on Friday, we had the jobs number. The jobs number came out. The NFPs came out on Friday. And what the market did initially, the market took off, right? Went straight up. And then in the first 15 minutes of the day, the cash session, so the market opens at 9:30, the market sold off, right? And then at 10 a.m., right around there, you had manufacturing data come out that was actually under 50% for the first time in 3 years. That was a very negative sign for the economy. Very negative sign. Contraction. That's what the Fed wants to see, or the market, right? And the market went skyrocketing since then. Now, when the jobs number came out, I thought, the expectations for the jobs created was 200,000. We saw 223. So that's not good for the market. That shouldn't be good for the equity market. The Fed wants to see this lower. The unemployment rate. This came in with a huge beat, 3.5%. Just an absolute one of the lowest numbers for unemployment. The Fed is still calling for in the fours. So that's not what the market would want to see, right? Still, the market went up. The average hourly earnings, this is the only thing, and the labor force participation. These two things were a very good sign from the jobs report. The average hourly earnings came down, right? Less than expected. It has been coming down all year. And the revisions from last month, because when you get the report, they put in there a lot of times revisions for the previous month. The average hourly earnings for the previous month actually came down as well. So also a very good sign that the Fed is working, it's doing its job. Maybe they will be less hawkish. Maybe we'll see a 0.25% increase in their federal funds rate, which would be, a lot different than what we have seen with the 75 basis points, the 50 basis points. So that would be good. Labor force participation. The Fed wants to see more people coming back into the workforce because that will make the average hourly earnings come on down. All right. So you hear this like Goldilocks jobs report. I wouldn't go that far because I still think 3.5% unemployment, while it's great for the economy, that's just not what the Fed wants. More jobs created than estimates, that's not what the Fed wants. All right. And then you have little beats here. I mean, that's very minimal beats here. So what I'm thinking and what we saw on Friday, the market shot up, gapped up big, sold off really fast. And then we saw those economic numbers come out at 10, and the market did not look back, went straight up. But the market was also at support. So you got to realize this market sentiment. We were at support. All right. We were trading at support where we have been for 4 months in that range, but we were at support when the market opened up. So it's very interesting, this market sentiment, and what's going to really get us to push either out through this consolidation or break down out of the consolidation. Because right now we did see a very nice day on Friday. We had higher volume than the day before. That's very good. And that's a clear sign that people were involved getting in for that breakout. But we have seen so many times these false breakouts, especially in this type of market. So just keep that in mind. But when this came out on Friday, this jobs report, when something like that happens and the market takes that as a sign that the Fed will start to back off and be more dovish instead of, we gotta hammer on the gas pedal. We gotta do a 50 basis point move, maybe a 75. That was a terrible report. That didn't happen. So what happens is the yields for the bonds goes down. Now, if they were thinking that it was going to be a hawkish Fed, right? Let's say a terrible report. These numbers here would go up, the yield. This works inversely to the actual bond price. So what the bonds did here on Friday was they rallied. A lot of money came into bonds. And that's why you see the yields actually go down, right? So that's a big move in the bonds. That certainly helped Friday's equity trading, right? When these yields come down like this, the equity market goes up, all right? So we went over that. Now we're going to jump into the SPY, right? So this is our compass. This is what we need to look at. I want to see, looking at a daily time frame, and we're going to look at a weekly time frame on the QQQ. Those bigger time frames give me a better idea of where I can see the market going. So coming into this this week, we were consolidating right here. Big time consolidation right in this box. So right around there. That was the most of the consolidation inside that box. We broke out of that. That was a break out of the consolidation, and we basically just filled this gap right here. There's some more gaps to fill, but there's a lot of consolidation here. And I find it funny, and at the time, obviously, we were up a lot, but it kind of rejected there at the 50 moving average. So this is going to be a very clear spot for us to see what is going to come next, right? That 50 moving average. We definitely rejected off of that during the day. Where do we go from here is going to be really important. And we have a very clear level with the volume profile right up here. Hang on one sec. So right here, this is the point of control. It's no wonder, and we've said this a lot, it's no wonder that we just traded and broke into this lack of liquidity right here. This is a big gap in liquidity. And you can just tell by this, one day, basically, this drop right here. This left a really big vacuum here to get filled. And that's where we are now. We're right here. We're right in the middle of it. So if we were going to go up any more, let's say we break the 50 and it turns into a false breakout, right? Where a couple of days, maybe it lasts 1 or 2 days above it. You have this massive point of control right here with a lot of volume. So this is where I can see that next resistance area. If we gap up, if we have, a good start to the week, that's a clear rejection area right here. Starting at the, 392s to 395. And then you have this downtrend line, you got the 200 SMA. Now, it's going to be tough to get through that. It really is going to be very tough to get through that. There's just a lot of supply there. So, while this has been a very nice start to the year, probably, one of the best weekly candles that we've had in a long time. And this is, that ascending trend line here that we saw support on. It was a breakout, but it's going to be a breakout into a lot of issues. That's what I see. That's just my personal opinion. It doesn't mean it has to happen, but this might run into some resistance here. So that's the SPY. And while we're on this volume profile, I want to show you guys something really interesting on the Qs. And I want to look at the Qs on the weekly chart, the 3-year weekly chart. This is what I see as possibly a huge issue. Now, this volume, it's taking from the last 3 years. So whatever chart you're on, that's where you're going to see where the most amount of volume has taken place. It's all taken place above us, right? If we break down below this key level here, this 260 area, look at this huge vacuum here that can get filled up. That could be a very, very nasty drop, as there's just not much support here. There's no volume created here in the last 3 years. The support doesn't go back down until 220 on the Qs. So this is a very key critical area. Looking at it on the daily chart, taking away the volume for now. You can see that's very clear as far as support goes. So that was good that we held up here. That was very good. We were making higher highs, higher highs, higher highs, higher highs until we hit that trend line, came back down, and then just could not seem to pierce lower, at least yet. But this is below the 20, below the 50, and below the 200. All right, so that's the Qs. Like I said, a very good day on Friday. The whole market had a very good day. Taking a look at the VIX, coming back down to 20. This is basically just chopped around down here, and this is showing us that the market right now is pretty content with where we're at. We haven't seen a spike. Look at this lack right here. Look at this big lack of any spikes into. We've seen it here, here. This is the way the market works, right? Now we're in this like quiet period. When the VIX spikes into these boxes, that means the market is dropping and dropping fast. We have not seen that yet. It's been very calm ever since October. We've had a couple of scares, but it's been very calm for 3 months. Will we see eventually another spike, another couple weeks of really rough trading? That can happen, especially if that Qs breaks down. So just things I'm showing you guys. Hopefully you take all this and do your own due diligence. I'm just here to show you maybe some things that you're missing, okay? So this is technicals on a lot of daily charts. And what I love when I do my picks, my charts that I want to watch for the week, I always look at the daily chart and then I look at some smaller time frames for, cleaner entries, exits, things like that. So let's get to the charts that I'm looking at for this week and this year. All right, this is one of them. This is NUGT. So this is Nugget, right? This is the gold miner. It's a leveraged gold miner that will go up at least double what the gold miners will go up. So like Barrick Gold, those type of stocks, this one will move very fast. And like we've seen since the start of the year, we opened up the year down here, closed almost 20% higher already. That's a great move in 4 trading days. That is a monster move. This is obviously a bottoming out pattern. Looks really good. We're now above all 3 indicators, and now we're coming into this 41 level that is going to be that first area of resistance. So there's a possibility that we can maybe get a pullback and a cleaner entry. All right. If this does pull back, I'm going to want to set alerts for maybe around 40, maybe around this 39 area to get long for that next move. Because you can see the way this moves, it moves up, comes down, moves up, consolidates, moves up, and now maybe you get that consolidation, or there's a possibility that it just goes on a run because it's the beginning of the year. A lot of people running portfolios are trying to get into gold. So gold is one of my favorite for this year. And one of those miners is Barrick. That's GOLD. Same thing. Very nice bottoming pattern, hit this nice trend, and then had a beautiful breakout. Above all the moving averages, looks really good. This is something that I would also suggest that you guys look at. So that's GOLD. Now, let's look at energy. Energy rejected here again at the 50-day moving average. Traded in a range here, broke down, right? Chopped around here for basically the last month or so in this range. What I'm going to be watching is to take this one back down. So if it doesn't break this 50, let's say, the price per oil, something like this doesn't rally for the week, this could be a good time to take it back down, although it's the beginning of the year. So, maybe people that aren't exposed to energy are trying to get more exposure. Maybe there was some selling that they did last year and now they're starting up more positions. Who knows what it is? You just got to be careful in that, the first couple weeks of the year. But, as far as technicals go, I'm going to be watching this rejection of the 50 to take this back on down to support, which would be right here. That 82 area. All right. Same thing holds for XOM. This is ExxonMobil. This tried a breakout on Friday all the way up to 112 and came all the way back down inside this range. So I don't look at this candle as very bullish on Friday. So we'll see what happens with that one. You can see this looks like XLE, right? ExxonMobil is a very big part of XLE. So if this goes up into this area, you got some overhead supply here, you have resistance. This one looking to maybe fade it, but it is over all of the moving averages. So it's looking very strong. You hate to trade against a chart like this, but something that trades in a range, it's a lower risk entry, right? If it breaks out, you could always just get out of the trade. That's fine, especially in a market like this when we're seeing a lot of these false breakouts. So it's XOM, Meta, the next one. This has been such a nice performer since this huge sell-off. It's been really holding up much stronger than the rest of the market. Really nice move all the way from the 80s to now 130. So you got that gap fill that happened here, right? Gap fill happened here, and then we broke out even more. So the next area I have on this one is going to be up here at the 200 or this 150 area, 155, which was obviously a clear floor before the break. So that's what I'm going to be looking at as the next spot for Meta to go to. And then a diamond in the rough. I don't know how many of you guys have heard of Supermicro, but this has been for the year, and this is a technology stock, has absolutely crushed the NASDAQ. Look at this chart from the bottom left to the top right. That's not what the Qs look like for the year. So this one has just been totally dominating while the rest of technology has gone down. So this is something that really, really catches my eye. So when I see something like this, and I read about this in the Investors Business Daily this week, that's how I even realized it. But I want to see and I want to look at the financials. So what I'll do is I'll come over here, I'll go on to Yahoo Finance, I'll click on statistics, and then I can see the PE, the market cap, I can see the price to sales, very attractive. I can see what I'm very interested in is that profitability and that growth. Look at this growth. Unbelievable. Unbelievable growth. Growth. While all the other tech stocks are showing negative growth or very small growth from year over year, this one is hitting its stride. And I actually read something from the CEO of Supermicro. They were extremely, the guidance for this year was really, really very positive. So, you know, this one is really looking good. Their revenue is $6 billion, and the CEO came on and said that they can easily see over $20 billion, not for this year, but in the future with the things that they're doing. So Supermicro, this is definitely one that I'm going to be keeping an eye on, not only for this year, but for years to come. I want to see this one and see how this stock plays out. I think that this is very, very interesting at the moment. They do a lot of, they make the like the motherboards, the processors. They use a lot of NVIDIA, AMD, Intel in their big data processing computers that they make for really big institutional customers. So this is a very interesting play. I don't think they do much for the personal computer, which is probably good because that market has been decimated. So many people went out and bought computers in the last 2 years. They do more on the high end for big companies. So SMCI, keep this one on watch for years to come. It's trading at a very, very good value, even where it's at right now. The price to sales, the earnings, it's all looking really good. Now, it's extended, but this is consolidation for maybe that next move up. So this can be a good stock to maybe add, to a longer term portfolio. Just something maybe if you guys weren't aware of. That's all I'm here for. Just to show you guys maybe something that you don't know. Hope that you guys learned a thing or two. And, please hit that thumbs up for the video. And I'll see you guys on the next one. Take care.